Like, you can actually run a fairly large business with a very low fixed OpEx.
There's also a certain amount of revenue that you may have to achieve just to continue operations and support OpEx. The most productive thing is probably to forecast with an assumption that tariffs are going to be around for at least the next handful of months. And that probably looks something like your worst case scenario.
All right, we're live. Dylan, how's it going this morning?
It's going well. We're almost twinning. Not too far off. I just realized this. It's all good.
Yeah,
It's all good. I'm excited to talk about tariffs. Everyone's favorite topic.
100% the T word. Cool. Well, we put out a blog a few weeks ago chatting through what brands can do kind of in this environment with the new tariff side. And I think that, like, before we jump into the topic today, this is not going to be really a podcast talking about the speculations around tariffs, what may happen to tariffs, but really just like practically what can brands do to best position themselves in an environment of uncertainty, specifically around this one area, which is impacting pretty much, I'd say, most merchants in some way, shape, or form. Some ways good, some ways bad. In most ways, I'd say posing new challenges that brands probably have not had to face for a while. With that said, we've kind of put together like 10 tactical things that brands can do to navigate these times. But before we jump into that, Dylan, maybe you want to give a quick intro on your side, who you are, what we do at Applo, et cetera.
Yeah, so at Applo Group, I'm one of the managing partners responsible for overseeing strategy on accounts ranging from a variety of things, but for the most part, paid acquisition and email and SMS strategy. So when thinking about growth planning and optimizing for a growth outcome, obviously how you move through units of inventory matter a lot. And if you are going to have a highly tariffed inventory, it adds another variable to how you think about your growth planning, and maybe requires you to adjust and re-underwrite your expectations for a period of time, depending on what you think is going to occur with tariffs. So I think that is a good segue into one of the first high-level points, which is maximizing your day's inventory. So this is like, it really depends where you're at in terms of your inventory position. I think that like most merchants in our experience are rarely having more than a couple of months of inventory on hand. If you're in the boat right now where you have a year, you're probably in a pretty good position. But if you have historically purchased for 2-3 month cycles, in that scenario, you have to think about, if I sell through all of it, what does it look like for me if I have to start moving units at a much higher price 2-3 months from now? If it's still economically viable, where your P&L can actually support it, depending on what you're selling, maybe maximizing your days inventory is not going to be what you want to do. But in the event that it's not economically viable, you have to start thinking about, what do I think is likely to happen in the next 6 to 12 months? If you choose to speculate that there's going to be de-escalation and the tariff rates are going to get better, you then become incentivized to basically be in a position to wait as much as you can. So then it's a balancing act of making sure that you kind of give yourself some estimate runway to increase the expected days inventory based off of the units you currently have. And whether that's going from 3 months to 4, 3 months to 5, how you kind of stretch that. There's also a certain amount of revenue that you may have to achieve just to continue operations and support OpEx. You also have to then look at your fixed costs and decide, like, do I really need all of these? Because maybe I can even support less volume if I have less fixed costs. So how long you choose to maximize your inventory on hand, it's very unique to how much inventory you already have. And then in the event that you have some options to play with, I think right now a lot of merchants are thinking, how do I kind of extend this a little bit? And that usually then really leads to some reduction in ad spend. There's also another kind of a situation where if consumer spending does not drop, a bunch of advertisers pull back, and you're in the position where whether maybe you're manufacturing domestically, maybe the tariff just isn't really that big of a deal for you, depending on where you're sourcing your products from, et cetera. Maybe this is actually a really good opportunity for you to start really being aggressive. So I think obviously the point of this is chatting through, in the event that you are heavily impacted by the tariffs, what are you going to do about it? But there are, like, to almost every single point in this kind of list of points that we've compiled here, there's almost always a upside variable too, depending on how you're positioned currently. So there's other tactics that can be used there as well. What do you think about that, Jacob?
Yeah, it's a good point. I think we should double down on what that actually means to extend your inventory or your days inventory, because inventory doesn't come out of thin air, right? It's not like we can, oh, okay, like how do you extend days inventory without going and purchasing more product? And I think what you're getting at, Dylan, is reduce the volume at which you sell through, which maybe means if you're heavily discounting right now, which we'll talk about in a little bit, should you be maybe re-underwriting that strategy and moving units at a higher contribution margin but a lower volume? Should you be pulling back on spend potentially and acquiring new customers a little bit slower? Does that mean that you're re-underwriting your revenue expectations for the quarter, for the year? Because again, it just doesn't make sense to kind of take the risk, roll the dice, if you think that maybe the tariff situation gets resolved in a few weeks or a few months, and you want to have just as much runway to kind of like wait and see, so to speak. So maybe we can chat a little bit through what that means to actually like give yourself more days inventory. But I agree in principle with everything you said. I think we can just double down maybe on that.
Yeah, so basically what you would do is you would look at your current sell-through of units per day and break out how much of it is first-time customers and returning customers. Generally, the first-time customer piece for most brands is probably going to be more correlated with advertising spend. And then based off of your new customer ROAS trends at different levels of spend and incrementality, basically have an estimate sell-through of your units at different spend levels and how that impacts both your new and return customer revenue in the months to come. And you're basically trying to thread the needle of identifying, I want to extend runway in this hypothetical, but I need to still have enough contribution margin dollars to pay for X, Y, or Z, or in this case, most likely just cash collected to pay for X, Y, or Z. So it kind of identifying that sweet spot. And let's say you have a target hypothetically of going from 3 months to 5 months, but with your current fixed costs, you can only go from 3 months to 4 months. Well, then how do you basically cut fixed costs to then go and do that extra month? And I think that there's so many, everyone can speculate on what's going to happen, but I think that if you're in the driver's seat of a growing business, you want to make sure you're positioning yourself to continue to grow. So you have to be very cognizant of what you cut if you choose to cut fixed costs. So for example, anything relating to the optimization of paid acquisition efforts, probably not the best place to go and cut spend. If you were doing a bunch of, studies or product development or this or that, maybe some of those things should wait until you get a bit more clarity into what that could look like in the future from a cost perspective. Because even if you finish some of that work today to inform an upcoming purchase order, you're probably, assuming that you are affected by the tariffs, unless you're sourcing it from somewhere else, you're probably not going to order it anyways. So it's just stripping down costs to, I want to be as efficient as possible. I still want to try to be growing coming out of this. I don't have to rebuild everything or structurally, organizationally, and doing that exercise. And again, this is so case by case. And again, there's so many brands who are crushing it right now as well. But if you are in that bucket of really impacted by tariffs, you have to start thinking about picking a timeline for when you want to just extend your current runway. And I think it starts with some of those decisions.
100%. And I guess there's an upper bound and lower bound. The lower bound would basically be you have some minimum contribution margin that you need to generate to cover those fixed costs you're talking about. But at the same time, if you can maybe pull back in certain places that are currently bucketed as fixed, you again are just creating you're creating more room to extend that runway even further, so to speak, if we're looking at it as a days inventory KPI. No, awesome. Let's jump into price testing. Price testing is kind of the next, I think, lever straight from days inventory. Obviously, we kind of looked at, well, how do you reduce volume? One is just reducing spend and how many new customers you're acquiring. The other could just be choosing to move units at potentially a higher price, a higher contribution margin. As a result, that can obviously impact what the total volume of units sold is because you're introducing more friction to the conversion process, let's say. Maybe we can talk a little bit about price testing, how merchants should be thinking about it. We're obviously big fans of IntelliGems. That's a price testing tool that we often use with our merchants on the, let's say, CRO and price testing side. So maybe we can chat a little bit through strategies there and what merchants should be looking at if they're going about price testing, just in general, but specifically in this moment in time. when it seems to be very important to understand what your prices should be, especially if you're reiterating COGS expectations, things like that.
Yeah. So I think that, so one of the counters to tariffs is if your COGS go up, you can raise price. The issue is that sometimes in doing so, your conversion rate will drop off. And then it's also a game of, well, what's greater, the increase in contribution margin dollars as a byproduct of that price increase, or the decrease in conversion rate that will likely occur. And what you're trying to hopefully achieve is that your AOV goes up more than your conversion rate goes down in terms of value created or profit per visitor or whatever metric you want to assign to it. Where price testing is a higher probability of solving a good chunk of this issue, it's unlikely to truly mitigate it entirely, but maybe it can help. Is if you're importing products where the COGS are like dollars, at the end of the day, no matter what your tariff rate is, depending on where you're importing from, that X% increase on like $2-3 is a lot more manageable than the X% increase on $20-30 or $200 to $300 or whatever like dollar value you want to assign to it. So if you're a relatively like low cost cost of goods brand, you might be able to solve a lot of this with price testing. That's not to say if you're a higher COGS brand that you can't help your situation with price testing, but there's so many more dollars you have to make up that changing your price from, I don't know, 150 to 155 or whatever it is, like that $5, if your COGS are $30-40, it's like, it's not as big of a swing in the event that they go up double or something. So price testing should definitely be something that brands are thinking about. And how you run that really depends on what you're selling and how you're sending traffic to it. So I don't want to get too in the weeds because it's very specific, but I totally agree intelligence is a great option. And in the event that you do have those lower COGS, definitely look here as one of the highest priority items, because you may surprise yourself as to how much additional value you can create just with a little bit of testing.
100%. It's also, would you say it's fair to look at this as like absolute dollars over like percentages? Because I would probably say like, if you're looking at that relationship between drop in conversion versus lift in contribution margin, you probably want to look at that in terms of like the actual total absolute dollars, right? It's
I think tariffs are percentages, but then like in terms of how they're generally like talked about, but yes, the way the merchant or the way a merchant should think about it is absolute dollars. And can you capture those additional dollars via price testing? And even if you can capture a good chunk of them, that's often great. So you don't have to you don't have to regain all of the margin just with one strategy. And this is also just a reminder that like in the event that you can fix a lot of this with price testing alone, and that won't be the majority, I don't think, but some brands I think actually may be able to. Mm-hmm. It kind of, well, when you come out of this, assuming the tariffs go back to where they were prior, you're going to be in a much stronger position. And it's a reminder that sometimes these difficult situations also force you to innovate or think about how can I improve my margin profile, and you find solutions like that. Or you're more interested in finding or trying solutions like that. Or maybe you were always like, I'm not sure I want to try that. Like, I really don't want to raise prices. I think the current price is good. I like giving this value to my customers. I don't want to have to increase it. But then you do it and you realize, well, actually it's a lot better for you. So it'll be interesting to see how many brands end up at a higher price and then stay at a higher price even once tariffs go away. I think there's actually going to be a good amount of that.
100%. And we also haven't talked about like price reductions, which I think in this context are not necessarily what makes the most sense, especially if we're going back to how do you increase your days inventory, etc. But there's also situations in which you actually could see like if you priced too high or too low if you priced too high and you could price slightly lower, the outsized gain in conversion value from effective discounting or just like where you price psychologically has such an outsized effect on like the friction and conversion that it actually helps in again, absolute dollars, even if your contribution as a percentage is lower, if that makes sense. So there's situations for both. And if brands haven't been price testing up to this point, it's probably a good idea. The stress test, so to speak, is a reminder of maybe why these kind of tests are good to do every once in a while. In that case, Dylan, maybe we move on to discounting since we kind of just segued into it already. but specifically in terms of like reducing what your discounting rate is. So again, maybe raising prices, maybe removing certain discounts. Now this has a lot of implications, right? Because let's say you're running a lot of up to 30, up to 40, maybe you're relying on discounts that are, sort of the larger round numbers. It's maybe not an up to 70 total like clear out, but maybe you're running fairly frequently throughout the quarter, like a high 30 to 40% off strategy on certain products. Is that something that you want to move away from as a merchant? And there's a lot of risk associated with that because that discount is maybe baked into the offer, like the product strategy, the offer itself, right? I think of bundled products where there's like a value offer, 30% off if you buy the largest bundle, for example. Well, that offer makes a lot of sense, but maybe it doesn't make sense today. So how should merchants think about that discounting strategy, especially if they're maybe like current strategy from an AOV perspective really relies on that, high discount incentive. I'll use one more example. Let's say you have a product that sells in packs, right? You maybe have a 4-pack, an 8-pack, maybe a 16-pack, 24-pack, something like that. And if you're buying the 24-pack, it's like 30% off. If you're buying the 4-pack or the 8-pack, you're not really getting a discount or something like that. Well, obviously, if you're trying to increase your days inventory, you would probably say, well, that's fine. We're not going to sell through the higher pack. But what if your cost, for example, like what if you're actually trying to guide as many people as possible towards the highest pack because your blended AOV actually makes a lot more sense from a CAC perspective? Because if you're just selling the 4-pack, it doesn't actually, from a contribution margin standpoint, make a whole lot of sense on the acquisition side. Like, I know there's scenarios like that pop up. How should brands think through that equation? Because, if you remove that discount right off the bat, like that kind of breaks the whole reason why someone would go and purchase something that is higher AOV, if that makes sense.
Yeah, I think that in the event that you're assuming that you still have inventory that was purchased at like prior pricing where the units still make sense, I think it's safer just to, if that's your core offer and that's what's also being promoted on paid, probably just keeping that as is. In the event that you're then starting to sell inventory that's highly tariffed and your costs change dramatically to the point that offer is no longer economically viable, I think that's where you start having to get into price testing. And you should probably move fast on that, even preemptively before you start needing to move some of those units for some percentage of your traffic to begin gathering data. It'll be very hard to move away from like the percentage value. If let's say you were selling at like your offer was like up to 40% off when you buy more, save more. So 1 unit is full price, 3 units is 10%, and it goes all the way up to 40% off at some volume. Ideally, if your ad account is heavily built around up to 40, you probably, if possible, assuming there's not like a much better economic option, and assuming you do raise prices, ideally trying to still stick with some model where the up to 40 still is valid, but by having like the full price when you buy in lower quantities be more expensive, so it all still works out from a buy more, save more standpoint. That's probably going to be better than having to change it, because you've established that offer communicated in ads converts well from a click-through rate standpoint and then goes on to convert. The question is, does it convert at the higher price point? So there's a world where you have to change it. But if you still have like regularly priced COGS, you're probably fine if you can extend your runway. If you're about to not have regularly priced COGS, you want to be price testing, I think, in advance of having to move. Like if let's just say like, I'd much rather have an idea on a small sample size of what I think my pricing should be a couple of weeks before I have to basically reprice everything versus having to figure it out all on the fly. So testing ahead of time in small quantities is probably important. And then depending on if my ad account heavily communicates an offer, because for a lot of buy more, save more offers, which are common in like CPG, a lot of the times they're not even communicated in ads because you're kind of selling the prospective customer on the benefits your product provides or why your product is so great. And they just happen to land on your page and then go, oh, I can buy more, save more. I already know I like the product. The ad got me. I just have to decide how much I want to buy now. Now, there are some where you do convey the offer in the ad itself. It really is brand to brand dependent. But it's also easier to change the offer if you're not really relying on it as some of your top performing ads. If your top performing ads are heavily about that offer, that's where I think you're going to have more risk. And that's where the reality is you may just have to change it in the event that you can't kind of reprice everything for the offer to still be valid and the conversion rates to hold.
100%. So that makes perfect sense in the CPG context. I think on the clothing and apparel side, brands run into a little bit more trouble here because typically catalogs kind of grow over time and they're a little bit larger. At least in our experience, like the CPG catalogs tend to just be a lot smaller in comparison to the clothing and apparel catalogs, just by nature, I think, of the category. One of the other points that we had, the next point after discounting is also limiting your total SKU count. And what we mean by this is long term, when you look at what your brand's, I don't know, 6 to 12 month, for example, next 6 to 12 months look like, I think looking at what your total SKU count is and which SKUs are actually essential versus which SKUs maybe you shouldn't even consider reordering, is another way to help mitigate some of the impact from the tariff side. Because if you're reordering products that are really not actually selling and you're kind of just sitting on them, this may be a good time to actually go and prune what that catalog looks like. But in the process of doing that, you may actually want to sort of fire sale some of these and just, if you're sitting on inventory that hasn't been moving, convert it into cash, albeit at maybe a lower contribution margin because you're discounting it more heavily. So it's interesting, right? Because we just talked about like, well, maybe you should reduce the amount you're actually discounting. On the other hand, if you're a clothing and apparel brand with a good amount of kind of SKUs that you don't plan to reorder anytime soon, because you only want to, if you're like trying to minimize the impact, ideally just order what you actually need to order because that's the 80-20 of your catalog. How should brands, I guess, think about that? Because you can discount those items if you're willing to, 40, 50, 60% off, for example. That actually would probably be higher discount than you usually run, depending on what your discount strategy is as a clothing and apparel brand. So yeah, I guess what's that balance? We're talking about not discounting, but we're also talking about limiting your SKU count. And if you want to limit your SKU count, one of the best ways to just get rid of the SKUs that are not working and not moving, and just not reorder them is just sell them at a discount. So yeah.
Yeah, I think like it kind of goes back to like, what is e-com? And it's basically the never ending game of trying to make educated decisions on how much and what to purchase and then turn that into cash on the other side. And of all the e-com kind of categories or niches you can opt to run, generally clothing and apparel is where you have, in our experience, the most money gets stuck in unproductive inventory. And now more than ever is probably the time to be very, very focused on moving those units. And maybe it also requires doing some promotions that you historically would not be comfortable with if it gets to a point where you really need the cash, because it might be nice to have some supplementary SKUs, but if you are all of a sudden looking at really expensive really expensive costs to just get landed inventory due to tariffs, you may need to come up with cash because X number of months ago when you were doing all your cash flow planning, you weren't pricing in that you were going to have to pay a certain amount of money to bring these units in. So getting more aggressive with that discounting strategy might make sense, even to a point where maybe it's contribution margin negative if it gets to a really difficult position, because that could still be net positive from a cash flow standpoint, which can help get through a hard time like this when all of a sudden COGS are very high. So I think that having an effective discount strategy is important. And let's just say like historically, I don't know, let's say you have like 50% gross margins after all your variable costs. And let's say you never, ever, ever have discounted more than 30%. Well, you should probably, if you're in a bad situation, start by discounting your overstock stuff by 30%. And then period over period, if it's not moving enough, just keep on raising that to do everything you possibly can to get dollars out of that unproductive inventory, to then have enough cash to just like continue to buy units. So you have like the important stuff to sell that hopefully is still selling at a contribution margin positive after the tariffs. Or you can also just look at it as if you're long those units, maybe you just want to increase your cash position on your balance sheet to feel more secure, to think, or not to think, but to actually have more runway. if you're speculating that the tariff situation is going to get better. So I think that there's times to hold firm on this is my these are my brand guidelines, these are my rules. I never want to discount more than X. But if you're heavily overstocked on certain things that are not popular and it's starting to get like existential crisis, business is on the line situations, you might want to decide to break some of those rules that you've set previously and think about it in advance, because this stuff also takes time. It's unpopular for a reason. So it's hard to move. So it might take you like weeks or months to sell these things and turn them into cash, even if you're discounting them at 60% off at a loss. But that can still support cash flow because you're at least turning an unproductive piece of clothing on a shelf into dollars. So,
Yeah, it makes perfect sense. You mentioned something really important, which is kind of the next point we'll jump into. It's the re-underwriting of your cash flow expectations that you maybe had at the start of the year. And you just talked about, maybe breaking some of those rules that you already had in place, re-underwriting what your assumptions are around discounting, things like that. I think one of the next points that we had on the tariff side, and this is something we'd recommend, like tariffs or no tariffs, like brands should be doing this, but the multi-scenario planning from a financial modeling and forecasting perspective, having multiple scenarios is, I think there's one thing that's true about forecasting, or like the first rule of forecasting is basically all forecasts are wrong, but some are useful. I think that kind of like is case in point for why you want to have multiple scenarios. You're looking at the probability of outcomes, and if certain outcomes take place, here's what that actually means in terms of my business results. So maybe we can talk a little bit through how brands should be re-underwriting some of their expectations for the year, for the quarter. And again, you mentioned also that in a lot of these cases, this can actually there's a lot of potential upside for brands in this moment. Now, there's obviously a lot of headwinds as well, and depending on what your inventory position looks like, where you're sourcing from, et cetera, you may be more or less impacted. There are some brands that stand to, depending on what their balance sheet looks like currently, stand to really capitalize on this if other competitors have to pull back, or maybe if there's like a secular movement towards, let's say you're a made in America brand, like that actually may be a really good time for you right now. Especially if you're like made in America, CPG, like locally sourced, like your impact in tariffs probably is a lot less felt than, for example, if you're clothing and apparel or durables with a very heavy reliance on supply chains in, sort of APAC. And you also have sort of these shorter windows in which you're buying inventory from just like a cash conversion, cash flow standpoint. So with that said, let's maybe chat the financial modeling perspective a little bit, just because I think there's a lot of re-underwriting happening as we speak.
Yeah. I think like in the spirit of scenarios, we can have upside and downside conversations, and there's so many potential upsides. So if a lot of brands start pulling back spend, but consumer spending and confidence stays high enough, you may find yourself, if you're manufactured domestically or somewhere where the tariff rate is low compared to your competitors, being able to all of a sudden really, really, really aggressively increase spend to a place where you can continue to eat up market share and maybe have more incrementality than you have in the past. And I think that there's going to be a good number of brands that have the ability to take advantage of that. And that's like the simplest way of putting it, but I think it is a simple concept, and it will occur for many brands that are in a good position from a cost standpoint. I think there's so many other potential benefits right now, some that maybe are a little bit outside of our area of expertise, but like even in retail, like if you all of a sudden if a giant retailer is looking at purchasing product from you and they are basically saying, oh, I can buy this super expensive good that just got imported, or I could try this new good that is much more economically viable and I can sell it at a reasonable price. Maybe now's the time. I was selling this company's thing before. Now I'm going to try this. You might be able to actually get into shelf space that you've never been able to occupy before because it was occupied by somebody else. But all of a sudden, do you really want to sell that good at such a markup, or does more importantly, do the retailers really want to sell it at such a markup because they just don't have confidence that the consumer is going to want to pay those prices? So there's so many opportunities if you are in a position where you're relatively unimpacted. And I think that when you think about your financial modeling and whether it's working with your marketing team, driving kind of like expectations for yield on growth at different amounts of spend and how that impacts contribution margin, or your finance team doing your cash flow planning, there are real upside scenarios you have to start thinking about. and real bets you might be able to make that weren't on the table months prior, from an upside opportunity standpoint. So that is one area of upside potential. And all of your forecasts should be rooted in data and historical data and the incremental data and the retention data that you have. But you might end up having some trends be broken to the upside in certain scenarios. So having some sensitivity analysis for what that could look like is wise. Then obviously you'll have your base case and then the downside scenarios and what it looks like. And we kind of touched on this earlier, but there might be a conversation of what is the minimum volume my business can maintain while still remain viable, and looking at that from a cash flow standpoint. I think the key word here is like cash flow. I think that like we often optimize and think about like profit and growth, and that's great. But in this environment, your cash flow planning becomes like infinitely more important. It was already arguably one of the most important exercises you can do, because again, it's the idea of buying inventory to then sell it to make more, your return on invested capital and how you deploy your cash. But I think when cash is getting tight like this, having someone on your team who actually has the ability to guide you through difficult times like this and understand how to manage risk and try to mitigate risk and have multiple scenarios built, I think is incredibly important.
100%. It's also funny because so far every point we've listed is not necessarily something you would do just because of tariffs. Like you should probably do all these things regardless.
Anyway.
The only thing that you can debate is, again, how many days of inventory do you want to keep at any point in time, and then again what your discounting expectations are with respect to volume and what you think that impact is on absolute dollars from that kind of price testing discussion. And this kind of goes into the next point, which we've already touched on when we discussed days inventory and how we kicked off the conversation, but assessing your OpEx and kind of reducing fixed overhead. So one of I think the highest, most undervalued levers of any e-commerce business, at least in my opinion, is they're very high leverage. Like you can actually run a fairly large business with a very low fixed OpEx. And again, it depends, what kind of where you are in your cycle in terms of how aggressively you're pushing growth, how you're expanding product, how your team and org are structured. But in general, like if needed, a good exercise along the lines of the multi-scenario planning is what minimum volume can you do with what minimum OpEx? That could be one thought exercise. You brought up this point, Dylan, of like, are there activities right now that are nice to have rather than essential that maybe could get put on the back burner? And you don't want to do this to, a point where you don't want to cut so deep that you're actually hurting the business and its trajectory overall. But there are some things that you can take an assessment, and basically, if you were to write down everything that you had planned at the start of this year to do, you can kind of go through the list and see which are nice to haves, goals that would be great to hit but not essential to hit, versus here are just our minimums that if we don't hit, the business is not solvent, or the business is going to be in a drastically worse place than how we started the year. How should brands think about that? I know you kind of touched on like, there are some activities that again are more essential than others, but maybe we can put a couple down for the audience.
Yeah, I think that anything that is directly responsible for driving performance and revenue, cutting that is probably relatively unsafe, because you have a risk of having an outcome where you start getting less return on ad spend as well, on top of worse margins, which can add to a further shrinking contribution margin post ad spend. So like I'd say keeping that in place is probably crucial, and then all of the things that go into that. So like there are just some key roles, in fact a lot of key roles that probably have to stay. But when you're thinking about your OpEx, it's basically going down the list, and it's like, I don't know, maybe you were about to like revamp your website and do like a big web development project or a rebrand. It's like, well, that's great, but if it's not mission critical today, it can probably wait 3 months. and thinking about what is not going to really impact my revenue for the next 3 months, and probably putting that on pause to preserve cash. And you can at the end of the day, like, you have to cut if you're not if even deeper than maybe you want to, if it's not economically viable to continue at your current fixed cost. And that may result in having to take to shoulder some burden yourself as an operator, depending on your size, or maybe certain members of your team temporarily have to shoulder some more burden that was previously shared amongst multiple team members or multiple third-party vendors. But you really want to avoid anything that is directly responsible for like revenue generation. So like maybe that's things like your like third-party tracking tools, incrementality testing tools. I'm just trying to think of examples that are related to the proper deployment of your ad dollars, because it's still important that you get a good yield on those. So that's where I go on that. I think that with where we're at with AI advancement too, and how that impacts workflows, I think that this could also have a positive impact on your business long term once tariffs go away, because you might learn that the org structure you had for the last 12 months is not the optimal org structure for the next 12 months, with what can now be automated and where the leverage actually goes from allocating human capital. I think that there are a lot of brands that can probably get more lean is maybe not even the wrong word, but there are a lot of roles that still exist that are slowly becoming more and more redundant's the wrong word, but low time input, because there's other ways to really get leverage out of the small amount of time put in, which frees up more time to be done or allocated to other areas with that person's kind of cost center, if you will. So I think it's, again, one of those things that's very difficult to give like all-encompassing advice, because org structures are so different brand to brand, but that's like directionally, I think, where I lean.
Totally. As like a good rule of thumb, I guess, you don't want to unplug the things that accelerate a potential, I don't want to use the word death spiral, but if you're already in a position where you have slightly less certainty around what your revenue looks like 1, 2, 3, 4 months from now, you ideally don't want to be unplugging the things that are driving that revenue. But what you do have control over are ultimately your costs, right? It's kind of one of those heuristics where you may not have control over your revenue, you may not have control over sort of external factors of your business, but you do have control over the internal factors, which are largely related to expenses. So if you can reduce your expenses in areas that don't really unplug the necessary kind of growth engine that still keeps the business alive, well, then you may want to consider that in this moment in time. And that doesn't mean, again, going away with it completely. It just might mean pausing certain initiatives that right now are not mission critical, so to speak. Then again, you also may be in a position where your balance sheet is very, very strong, and this is not having a major impact on your business. And it may, again, be just a really great time to kind of push further ahead. But that's something that needs to be done with a lot of kind of careful thought and some amount of planning, right? Because you don't want to be in a position where you sort of put your head in the sand, keep assuming everything's running as normal, and then 2 months down the line have really just wished that there was a little bit more cash being retained in the business rather than spent on activities that, again, are nice to haves when things are going great and virtually irrelevant if the business is not in a position to even benefit from these activities 2 months down the line, because it's just in a much worse spot than it was when it started.
100%. Jumping
we
into
can,
the next.
yeah, I was just gonna say, I think we can jump into the COGS piece as well. So Dylan, how should brands think about this? This is obviously around optimizing for future COGS as well. You have the current sort of what you've already paid for, what sits on your balance sheet. But as you look ahead, there may be some things that you can do from a packaging standpoint to reduce certain costs, input costs. Like, I guess, how should brands think about right-sizing their cost of goods, let's say, as they look ahead, post-tariffs, with tariffs, etc.?
I mean, so there's all the strategies that exist day to day, regardless, tariff free. You can try to identify, like, maybe as you ship maybe shipping 4 items is way more economical than shipping one. So that's implementing to buy more, save more. Pretty like that's an example of optimizing your. I guess that's not COGS. That's like variable cost. But to me, I think you want to look at all your variable costs and how you can have them work together to reach a better outcome. Um, and I think like the one thing you can probably do in a situation like this is your supplier is probably also hurting if you are hurting. And it's possible that you can go to them and basically have a lot of negotiation leverage in the sense that in order for you to start to continue ordering anything or in a respective or in like a reasonable volume relating to where you've historically ordered, you may need to have them shoulder part of the burden by lowering your cost. And depending on how much they're hurting and what their situation looks like, they may be more likely than ever to do that for you. And that's probably not going to be a great outcome for them. It's probably not going to be a great outcome for you anyways, because the tariffs are still probably incredibly high, but it's probably a better outcome for both of you than nothing getting ordered. So I think that's like the main thing. And how do you go to them and basically have that conversation? And that's why relationships with manufacturers matter so much. But I'd say that's probably where I would go first, just on the COGS side. And then when we talk about like the future beyond that, how you handle that as tariffs go away is a whole other thing to figure out. But I think in the immediate term, that's where my head goes. How about you, Jacob?
Well, my head goes to a slightly different place. Agreed with everything you said, but I'm wondering now, every point we just talked about it's almost like a holding pattern. It's like assess, give yourself runway, free up cash flow, and basically just build up a strategic stockpile, whether it's of inventory, of cash, and just make it through to kind of this next milestone. But the next milestone's unclear. It's unclear when it's coming, if it's coming, what that actually means, etc. So where my mind goes is like, let's say a month from now, there's a lot more clarity around what the medium to long-term state of tariffs looks like. I wonder if that's going to result in sort of this like coiled spring effect to the other side, where now there's going to be an increased demand from everyone who's basically put off certain decisions around making inventory POs. And there's going to be almost this like shortage in supply, or at least in freight space, et cetera, to actually bring it all back, if that makes sense. So if you're shipping from overseas, like, will we see container prices rise? Will we see more merchants having to airship things in, and will air shipment prices go up, et cetera? And I know that's not necessarily in COGS, but if you look at like landed COGS altogether, and then you layer on tariffs on top of that, will there be some sort of like competitive environment that even if you can get your COGS the same or down plus the tariff on top, will there also be this additional like hidden like component that is basically now, I don't know, the competitive premium, let's say, that the market's going to charge because you have this supply shock in the other direction? And just, again, by nature of there being clarity around tariffs, everyone now wanting to get their orders in with suppliers, bring over inventory and kind of continue along the way, and keep growing, keep selling, because again, now they can, now they know what's happening. So I don't know, What are your thoughts there? Like that's been one thing that I've been trying to wrap my head around, is like,
Yeah,
we just in a month from now see what we kind of saw during COVID at one point.
Yeah, I don't think I know enough about how the logistics piece of all the import backlog that will occur to know how much things are going to go up. Logically, I think things are going to go up a lot, but if I'm thinking about my purchase orders and how I'm going to import product in, and if I'm in that situation, I am assuming that once things get fixed, things are going to be more expensive. And also factoring that in to the point where, back to like the runway discussion, if I am lucky enough to be sitting in a position where I'm like flush with inventory, once things open again, I may be more inclined to start shipping very small amounts initially, or none if I can, and try to have some baseline expectation for how long I expect costs to be a lot higher. I think that there are probably other experts out there, or in looking at historical data with an AI tool to basically try to do some research for you to understand based off of historical volumes and what was likely backlogged, how long it's going to take for some of these things to normalize. And I don't think anyone has a crystal ball, but even if it's like just a little bit right along the way, it'll probably, if you can wait, you will probably be in a better situation from a pricing standpoint. And I think it's a great point and something that people have to take into account as well.
100%. And I think this kind of perfectly segues into our next point, which is the underwriting of, or the re-underwriting of growth expectations, which we've touched on in a number of ways before, because I think it's just like, it's part of the entire conversation, right? Whether it's re-underwriting your expectations around, again, inventory volume, whether it's sales volume, whether it's re-underwriting expectations around like what you thought you would grow at this year, or to what kind of like final annual sales, if it's a revenue target, if it's a profit target, et cetera. So, I mean, right now we are going through a good amount of uncertainty, which by definition is the time to kind of re-underwrite what your growth expectations are. But maybe Dylan, what should brands kind of be thinking about from a re-underwriting perspective, or at least where should they start, right? Is it re-underwriting what your expectations are around certain marketing efficiency metrics, or like sales volume, what you should be spending around? Like, is there any room for discussion around like an expectation that efficiency metrics may be impacted by this, either positively or negatively? Like, how, I guess, where should a brand start if they're re-underwriting what their growth model looks like?
Yeah. If you're a brand that can afford to plan in smaller timeframes, i.e. 3-month forecasts instead of 12-month forecasts, you're probably going to have a higher probability of being right. I mean, generally speaking, when you forecast shorter distances into the future, you're normally going to be more accurate than trying to forecast like multiple years into the future. There's more, over a longer period of time, there's more likely to be change in some of the main variables that would impact the accuracy of your forecast.
And sorry, also Dylan, and just for the audience, also there's this compounding error, right?
Yeah.
If you're wrong in month 2 and that impacts month 3, well then, by the time you get to month 12, the compounding error is
big,
quite dramatic. So yeah.
So I think that like longer term forecasts are just going to be downright hard. You don't know what's going to happen to the economy if this continues. I think a lot of people are speculating it's not going to continue long enough to have like the worst of all the outcomes possible. But you also don't know how long it's going to last. So without understanding those, like, firstly, without understanding what the tariff will be, if there will be them in certain categories or from certain places, and when that's all going to change, it is very, very difficult. So I think like the most productive thing is probably to forecast with an assumption that tariffs are going to be around for at least the next handful of months. And that probably looks something like your worst case scenario. I mean, maybe tariffs go up even more, but I think at this point it's like, well, they're pretty high. So I think at least from what I've listened to and heard, it seems like we're pointing towards some amount of de-escalation, hopefully. So I would kind of start there as like my downside scenario. I just take it in the smallest chunk of time frame that I can. I think that it's still important to then extrapolate what you think will happen on the longer term time frames on like on a longer term forecast. But you have to understand that the probability you assign to it coming true is probably lower than it was at the beginning of the year. And then if you're a brand that can either stomach the tariffs and or is arguably in a better position because of the tariffs, that's just where you may have to re-underwrite your expectations to the upside and also start having some scenario planning conversations about some bets you want to make. And then also keeping in the back of your mind that even though things may be looking better for you now because you are in a position where you can take up market share, there are potential repercussions that this all could have to consumer spending and confidence in the coming months or later in the year that could still impact you negatively. So you have to also weigh those two things where you're incredibly well positioned compared to your competition, but what's impacting your competition is so big that in a longer roundabout way, it can also come back and impact you. So I think it's just important to once again think about scenario planning and think about what time frame you're forecasting.